But the IT pack well, views have been different across brokerages. Let's get in the view from IIFL. Anirudh Mehta, analyst of the India Private Clients at IIFL, joins us right now on the show to talk about his sense of the numbers that have come out till now. 50% of the top heavy IT pack numbers are out, and they have been completely poles apart, both TCS as well as Infosys. Anirudh, are you with the majority of the street? Good morning, firstly. Thanks so much for joining in. Are you with the majority of the street, which has given the verdict that TCS remains the safe haven, get out of Infosys, get into TCS, despite the valuation differential?
True. I think overall yesterday was, as you said, the results were poles apart, and we believe Infosys results were pretty bad as expected, and even worse than expected, and TCS even performed better than expected. So we continue to believe that TCS is a safe haven. We believe so, but currently, considering the valuations that the stock is at, we feel the upsides are a bit limited at this point of time.
So Anirudh, is it time now to go cautious on the entire sector, considering the gloomy macro picture right now? And what would your rating be on both TCS as well as Infosys? Because there are some brokerages which have reduced both the stocks to now reduce, and they've slashed their target prices as well.
I do not think we should go negative on the whole pack. There are companies who are growing better than the industry, especially in the mid cap, and also companies like TCS and HCL Tech who have been consistent in their performance. So considering this, we feel that there should be a churn from towards these players like TCS and HCL Tech in the top tier, and other players in the mid cap. For TCS, we have a target of around 1350, and for HCL Tech we have a target around 580, 600.
Anirudh, that's my next question to you. What does your note advise clients to do? Is it that get out of Infosys and get into TCS despite the valuation differential, or is there a play existing wherein you look at some of the active mid-cap IT names, or look at within the large cap IT pack and look at HCL Tech, and therefore reduce your weightage on Infosys, yes, but probably not go into TCS and go into some of the other stronger names which are also delivering, because they are trading at substantially low valuations?
Neeraj, I think the valuation differential argument has to be stopped for some period of time when comparing TCS and Infosys. They are clearly going on a different path right now. The growth is different, the margin performance, the kind of commentary. So we clearly believe that TCS is a stock to be in if you are into the stock, but the upsides are limited. So one would rather invest in companies like HCL Tech and probably Wipro somewhere down the line, which have good valuations, attractive valuations, and can provide good results and better upsides.
What about the mid-cap IT space? Would Hexaware still continue to be a favorite?
I think Hexaware is not in coverage, but the valuations of the stock are rich, as it has run up quite a bit in past many quarters. And other mid-cap names like Mindtree or maybe Mahindra Satyam are more attractive to us at this point of time, which are providing strong growth as well as good deal wins and at good valuations.
Okay, Anirudh, the other question mark is with TCS itself. What does one do? Is this? I heard you mention that TCS is a good stock if you are already invested in the stock. What about somebody who's not invested in? Is it a good stock to buy, looking at the fact that the macro conditions for the market as a whole remain a bit skeptic, so you never know what the market would do, and therefore you go for the safest of the IT stocks, which has demonstrated over the last 6 quarters an ability to outperform even when the conditions are tough? Is that an argument a valid one?
Yeah, it can be a valid argument, considering there are lesser sectors to go into at this point of time. Considering TCS, the growth rate we expect over the next year is around 12 to 14% in the dollar revenue terms. The growth in the stock would be in the similar range. So investor which has a lesser return appetite would probably can invest and with a lower risk appetite. So can go ahead with TCS at this point of time.
Okay, Anirudh, purely from a results perspective, with Infi and TCS out of the way, what's your top bet now? Assuming that these companies deliver on the expectations that you had, what would your best results play be? Either Wipro or HCL Tech or any of the mid-cap IT names?
I think one in the mid-cap would be Mahindra Satyam. The valuations are still attractive and we expect the results to be good. And in the top tier, we think HCL Tech would be a good performer as far as results are concerned. We expect around 3%, 2 to 3% of dollar revenue growth for the company and stable margins. So our pick for the result perspective is HCL Tech as well as Mahindra Satyam.